Hi, greetings. It's me, Dr. Paul Gerhardt, and this is video number 13 of our Entrepreneur series. And it's interesting that it's the unlucky number 13 that we just happen to be talking about exiting or harvest turnaround. So let's get into this video. It really is important to consider this issue of when to exit and how to exit your business. And this is something that a lot of small business owners have to consider. So in your small business plan, you really have to have an exit plan or a harvesting plan. And this video is going to outline some of the basic steps for selling your business and discuss turnaround even if your business is declining. And then we're going to talk about some of the implications involved in closing your business. So there is always a need to at least consider what exiting or harvesting looks like. And you have to consider what the ideal planning is. Some steps for selling a business include valuation, preparing a business for sales, seeking buyers, and negotiation of sales. And then the turnaround and business in decline needs to be considered, and implications and issues involved in closing a business. So, why would you consider an exit or a harvest right now? In early stages as an entrepreneur, you need a well-defined exit plan before personalities clash. And the key is an accurate valuation, which helps provide insight, obtain loans, attract investors, field potential buyout offers, and benchmarks a true starting point. So why consider this? Well, maybe the business is successful but really no longer enjoyable for you. Or maybe there are other opportunities and you just don't have the time. And let's face it, sometimes the future just changes, your priorities. And so you gotta understand the steps for selling a business. So when you're selling or harvesting a business, there's a series of steps that occur. First is to develop a sense of true value of the business. 2, prepare the business to be sold. And then 3, and negotiate the actual sale of the business. Sounds easy enough, right? Let's talk about valuation. Public companies are a little bit easier because they have an assessed established marketable capitalization. The value is a starting point in negotiations, and calculating the premium above the market capitalization is a matter of negotiation. So these issues are typically different with private or smaller firms. New business really is considered a private firm. So when you've got to make sure that essentially you're going to pay out the founders through bonuses and perks to minimize tax. Fewer taxes means the business appears to be worth less than it's worth to the owner. You have to consider the benefits paid for by the company. Some examples include vacations, vehicles, loans, gifts, financial contributions to retirement plans, any number of things. Valuing a private firm, there are a large number of unique systems for evaluating a private business, and you have to use the most common methods in order to estimate the value of a firm. So 1, discounted future net cash flow. 2, price earnings valuation. 3, asset-based valuation. 4, capitalization of earnings valuation. And 5, market estimation valuation. So with discounted future net cash flow, it's the most widely accepted method of valuation. You have to estimate 5 years of cash flow and add a salvage value for a ballpark floor valuation. The founders should provide a list of assumptions on which the estimates are based, and a discount by some rate to account for risk. And the general rule of thumb is about 30%. Discount projected cash flows back to today's dollar. So with your your PE ratio, your price earnings valuation, you have to locate the PE ratio for public companies, multiply that average by the net cash flow for a 5-year discounted back as a sales price in year number 6, and at a 30% discount rate, for instance, that would be 4.826. So your PE ratio is the value derived from public companies that divides the current earnings per share into the price per share. So here's how you do PE valuation. So you take a look at the PE for the industry, and that can be obtained from industry sources. You take a look at net cash flow for 5 years, and so maybe that's $446,000. And then you consider a discount rate. We'll use 30% here. You take your sales divided by residual value. So that is 446 divided by, or times 10, and so that equals 4,460,000. You divide that by 1.3, that's your discounted sales price. And so essentially you get $4,460,000 divided by 4.826, and that will give you about 924. So your discounted cash flow would be 182,194 plus your discounted sales price, which ended up being 9,200 or 9,024, and which gives you a current value of approximately 1,106,199. So don't check my math. Asset-based valuation. This is the goodwill value, which is the general premium offered for new acquisitions. If the company is performing poorly, there's really no goodwill value. So typically returns will come from the lowest valuation number, and it works best for firms with hard assets. So asset valuation, by the way, is a method of a business valuation that simply totals all the hard assets of the organization and adds in goodwill. So that's asset value, asset-based valuation. So for instance, you can add up the building, that's the market value minus mortgage, your equipment total, your furniture total, your cash marketable securities, which leaves a total asset value, and your total asset value. And so you can take your total asset value times acquisition premium to get the business value. So capitalization of earnings valuation. This is a method of valuation achieved by taking the earnings, or your net profit, of the organization, subtracting or adding any unusual items that the lender or investor feels are not customary, normal, or usual items, and then dividing that figure by the capitalization rate. So it's similar to asset valuation, but the rate is based loosely on the nature of the business, and it's generally an agreed upon number. So for capitalization of earnings, you take your net profit or your earnings of the company, and you divide it by the capitalization rate, maybe it's 0.2, and that will give you the earnings. So market estimation valuation. This really involves taking the earnings of the business and multiplying that figure by the market premium of companies in that industry. And it really is the simplest of all the techniques. You can use the NASDAQ or the New York Stock Exchange to estimate the market premium. This is also called an industry multiple, and it's used to calculate the value. So for instance, you take net profit or the earnings of the company, and then you look at the industry multiple, and maybe that number is 13, and it's simple. You just multiply the two together to get your market estimation. So for valuation overview, it uses different valuation methods which result in potentially wide variations. So every company has unique features, and these a sustainable competitive advantage should be considered when valuing the business. So what makes your company unique can be an asset. It should be considered an asset. So when you're preparing the business for a sale, you have to have a transition plan that makes a sale more viable. You have to examine operations, codify and simplify procedures. For adding legitimacy, you must have a contract, and I would highly recommend that you get a CPA to audit last year's financial statements, standardized statement format, develop procedures for the accounting of all activities, provide an audit for this year's financial statements, and render an accounting opinion. So you should be able to obtain a professional valuation of the business and record all information practices of the company, plan for the type of the sale that will maximize your returns, and then the best method really depends on the type of business you have. If you have a specialized business like hospitals, hospital auditing, you make the process of selling a business more complicated, and so you really have to know your business inside and out and really understand some things that should be considered in valuation of the business. So when you're seeking to sell the business, you should make sure you're interacting with a third party. You could sell to a competitor or a larger business. You can divest portions to maximize the value, or you can make an IPO, and that may not be profitable. And so an IPO is an initial public offering. So this is when you make your sales go public. You can put your business up for sale just straight up, and you can get the word out in several different ways. You can hire a business broker to do that. You can contact people who have expressed interest in your business. You can let your accountant and lawyer know. Everybody's got a network. And then you can contact your suppliers and significant clients. Use your network wisely to help you sell your business. So a sale is based on the needs of both parties. In selling, it's all about perceived value. And some things that you should consider is using a professional mediator. Know the buyer, get to know your buyer, retain your own advisors, recognize all options for selling the business, and get cash for the firm. And then really make sure you're looking deeply into the details. Your business may be on the decline sooner or later, and so you really have to take a look at trends. And sometimes, if you are really savvy, you can create a plan of action to reverse this decline and turn things around. We call that turnaround. You really must use all your resources you can to really take a look at the bigger picture of who you are and where you're going. Too much out of control could really deteriorate your business significantly more. You got to have sufficient cash flow. And so you have to be very, very clear about your operating expenses and be very clear about how you strategically go about things. And so very often you can bring people in from the outside to help create some solutions. So very often some people will use remodeling to turn things around, and so it gives things a fresh new look and feel. Sometimes when things get really bad, you just got to declare bankruptcy, and this is why it really is important to make sure that you are a corporation like an LLC, so that it doesn't affect your personal assets. So Chapter 11, this allows for reorganization, and this is really pretty much a fast track, and if you have less debts than $2 million. Chapter 7 is used when the business has to close. Chapter 12 is used by family farming businesses. Chapter 13 is used by sole proprietors. So the business form may impact personal assets upon closing. So this is why it's important as you create your business plan that you be very clear on what kind of business entity you are. All right, so giving you a lot of numbers and things to consider. Hopefully when you're putting together your small business plan, that this all really makes sense, that you got to have an exit plan. You got to understand what things to look at and understand what is important in valuing your business and what potential investors will consider, and even considering what factors as you head towards bankruptcy that you must consider. So anyway, I hope you found something valuable in this video, and more than that, as always, I hope that you have a great day, because only you get to choose how you feel about it.